Dear all, welcome to PMS Insights. In this edition, we will be discussing the recently concluded budget and its impact on the Indian economy and the equity market. Given the backdrop of the economy coming out of a COVID induced recession, there were a lot of expectations from the budget in terms of providing stimulus for growth. The government has delivered a budget that meets these heightened expectations. There has been a clear focus towards growth revival, with fiscal deficit being sharply revised upwards to 9.5% of GDP in FY21 and 6.8% in FY22, thus undertaking a strong counter cyclical measure to revive growth. Medium term fiscal glide path has also been significantly revised upwards to 4.5% of GDP by FY26 as compared to earlier guidance of reaching to 3.1% deficit by FY23, indicating elevated spending over the next 5 years, especially on capital expenditure. Prudently allowing state governments to have higher deficits for the next 2 years, particularly for capital expenditure, the Centre has also recognized their role in supporting aggregate demand. We expect strong government expenditure momentum, which started from October as economy opened up, may continue in Q4 in order to revive the economy. Capex has been budgeted to grow at a faster pace of 26% in FY22 to Rs 5.5 trillion or 2.5% of GDP. Infra spend has gained momentum with drinking water, road, metro projects, power, and Swachh Bharat mission have seen the maximum increase in allocation over FY21. Setting up of a development finance institution capitalized with 20,000 crore and with a target to build a rupees 5 lakh crore lending portfolio in 3 years is a big positive. This should drive foreign investment and augment funds to drive growth in the infrastructure sector. What gives us comfort is that the budget math seems conservative and realistic, with nominal GDP growth assumption of 4.6% CAGR over FY20 and revenue receipts assumption of 3% over FY20. Besides, off balance sheet funding of subsidies in earlier years are now accounted as part of the budget estimates, providing higher transparency to the whole exercise. Moreover, there was no negative news for taxpayers in terms of change in tax rates, COVID cess, etc. A stable tax regime has removed a major overhang which is contributing to the positive sentiment. To fund the higher expenditure, the government has budgeted for higher net borrowing of Rs 9.7 lakh crore in FY22. FY22 Union Budget also unveiled a series of reforms to help achieve India's potential GDP growth rate through supply side measures, namely establishment of development financial institution and bad bank, strategic divestment along with IPO of LIC, asset monetization pipeline, and increase in FDI limit in insurance from 49 to 74%. In summary, the budget is pro growth, conservative in assumptions, and transparent. From a sector perspective, key beneficiaries of this budget would be domestic cyclical sectors like financials, industrials, cement, and discretionary consumption. The focus of the market will now shift back to recovery in earnings growth, which has held up well thus far. In this backdrop, we continue to remain positive on the overall construct of equity markets and expect the rally to broad-base in the next 12 to 18 months. Coming to our portfolio positioning, we increased weightage in domestic cyclicals and select mid and small caps over the last 6 months. While we continue to have high exposure to COVID resistant sectors like telecom and IT, we now have healthy exposure to sectors like banks and financials, cement, auto and auto ancillary, manufacturing, infra, and select small and mid caps, which could see strong growth over the next few years. We continue to stick to our strategy of identifying companies which have good management, strong balance sheet, and are seeing a turnaround in earnings trajectory due to macro and micro factors, along with ownership of structural high growth names. Thank you.